What if one decision in Washington could make your mortgage, car loan, and credit card more expensive overnight? That's exactly what's happening. So, who makes these decisions? Meet the Federal Reserve. This is the central bank. It helps steer America's economy. So why raise interest rates? The Federal Reserve does it to slow inflation and keep rising prices under control. When inflation stays high, everyday essentials become more expensive. From groceries to rent, Americans end up paying more for the same things. To slow inflation, the Federal Reserve raises interest rates. Higher borrowing costs reduce spending, helping bring prices back under control. Higher interest rates make mortgages more expensive. That means higher monthly payments, fewer homeburgers, and a slower housing market. Credit cards become more expensive too. As interest rates rise, carrying a balance can cost Americans hundreds of extra dollars each year. Higher interest rates don't just affect families. Small businesses also face higher borrowing costs, making it harder to grow, hire, and invest. When interest rates rise, investors pay close attention. Higher borrowing costs can slow company growth, causing stock prices to become more volatile. Higher interest rates often strengthen the US dollar. That attracts global investors. But it can also make American exports more expensive around the world. For millions of American families, higher interest rates can mean tougher financial choices. Every word from the Federal Reserve can move the markets. Investors closely watch inflation, jobs, and economic data for clues about the next rate decision.
Then comes decision day. Markets around the world pause as the Federal Reserve announces whether interest rates will rise, fall, or stay the same.
If the Federal Reserve raises rates again, borrowing could become even more expensive, slowing spending, investment, and economic growth.
But what if the Fed starts cutting interest rates? Borrowing could become cheaper, encouraging families and businesses to spend and invest again.
The Federal Reserve's biggest challenge is achieving a soft landing, slowing inflation without pushing the U.S. economy into a recession.
So, what happens next? Everything depends on inflation, jobs, and how the economy responds over the next few months. If inflation keeps falling, the economy could achieve a soft landing. But if inflation stays stubbornly high, more rate hikes could slow growth even further. So, what should Americans watch next? Inflation, job growth, consumer spending, and GDP will all help determine the Federal Reserve's next move. The Federal Reserve's next decision could shape America's economy for months to come. Stay informed, because what happens next could affect us all. So, what do economists expect? Many believe the Federal Reserve will closely monitor inflation and employment before making its next move. Inflation is one of the Federal Reserve's biggest concerns. If prices keep rising too quickly, interest rates may stay higher for longer.
The job market is another key signal. Strong hiring can keep inflation elevated, while slower hiring may reduce pressure on prices.
The months ahead could shape America's economic future. Every inflation report, jobs update, and Fed decision will help determine what comes next.
Businesses are adapting too. Many companies are delaying expansion, managing costs carefully, and waiting for clearer signals from the Federal Reserve.
Consumer spending powers much of the U.S. economy. When families feel confident, they spend more. When confidence falls, economic growth can slow. Retail sales reveal how confident Americans feel about spending. Strong sales often signal a healthy economy, while weaker sales may point to slower growth. Manufacturing is another key indicator. When factories increase production, it often signals stronger economic growth and rising business confidence. The U.S. economy doesn't operate alone. Trade with countries around the world influences jobs, prices, and long-term economic growth.
The U.S. dollar is the world's leading reserve currency. Its strength influences global trade, international investments, and financial markets across the globe.
Investors around the world closely watch every Federal Reserve meeting. Even a small policy change can move global markets within minutes. Financial markets react instantly to major economic news. A single inflation report or Federal Reserve announcement can change investor confidence in seconds. Inflation reports are among the most important economic updates. Lower inflation may reduce pressure for higher interest rates, while higher inflation can keep rates elevated. Another report investors watch closely is the monthly jobs report. Strong hiring can influence the Federal Reserve's next interest rate decision. Every major economic report can move Wall Street. Investors quickly adjust their expectations based on new data and the Federal Reserve's outlook. For homebuyers, higher interest rates usually mean larger monthly mortgage payments. That can make buying a home more difficult and reduce demand in the housing market.
When borrowing becomes more expensive, families often spend less. That can slow retail sales, travel, dining, and other parts of the economy.
Small businesses often feel higher interest rates first. More expensive loans can delay expansion, hiring, and investment in new equipment. As businesses slow their spending, hiring may also slow. Companies often become more cautious before adding new jobs. Gross Domestic Product, or GDP, measures the total value of goods and services produced in America. Strong GDP growth usually signals a healthy economy. The U.S. economy now stands at a crossroads. One path leads to steady growth, while the other risks slower growth if inflation remains too high. In the coming weeks, investors will focus on inflation, jobs, retail sales, and GDP. These reports could shape the Federal Reserve's next decision. Smart investors don't focus on just one headline. They watch trends over time, looking at inflation, earnings, interest rates, and consumer confidence together. No one can predict the future with certainty, but over the next 12 months, inflation, jobs, and Federal Reserve decisions will play a major role in shaping America's economy. The economy affects everyone. Understanding inflation, interest rates, and the Federal Reserve can help you make smarter financial decisions. The future isn't written yet. America's next chapter will depend on innovation, smart policies, resilient businesses, and the choices made by millions of people every day. The Federal Reserve's next decision won't just affect Wall Street. It could influence mortgages, jobs, savings, businesses, and the everyday lives of millions of Americans. So here's the bottom line. Inflation, jobs, and interest rates are all connected. Every Federal Reserve decision helps shape the direction of the U.S. economy. The next Federal Reserve decision could shape the future of the U.S. economy. Thanks for watching. Stay informed, stay curious, and we'll see you in the next video.